All right. Today is Monday, June 13th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. What a day, what a day, what a day. Baby Black Monday. Give us the Elmo with the fire. Give us the nuclear bomb. Matter of fact, give us the asteroid, the end of life. Everything was down today. Stocks down. Dow Jones is down. S&P down. NASDAQ down. Tulips down, Bitcoin down, Ethereum down, gold down, oil down. Everything is down, with the exception of Coca-Cola. Well, it was kind of up and then it finished flat, but flat is good in this massacre. Why did Coca-Cola end up flat? Well, today Coca-Cola announced a new innovation, this new technology where you mix Coke and Jack Daniels and you put them in a can, aka Jack and Coke, aka my favorite drink when I was 13. But boy, oh boy, it was a bloodbath. The heat map right across the board, blood all over the place. And I know what you're going to say. We don't need Jerome Powell to stop the bleeding. Perhaps the stock market needs a tampon. Well, I got bad news for you. Apparently, we have a tampon. Is that how you say it in the South? Tampon. I don't mean to make fun of Southerners. I lived in the South before. Wonderful people. Anyways, we have a tampon shortage. No more tampons. Keep bleeding. Who cares? I mean, I thought ladies were into vampires, but this is too much. But this tampon shortage, folks, oh, it's making things a lot worse. Who's going to stop the bleeding in the crypto market, for example? Oof, what a beating. Tulips got absolutely crushed today. But remember, fortune favors the brave. You might have lost all your money and now you have to take a job in McDonald's, but at least you're brave. And you know us bears, we don't mind brave people. We love bravery. And here's a guy who says El Salvador is now going to become a fourth world country. Wow. I'd say about 3 days and what's his face to the president. Well, he's going to get assassinated, but you might also want to say a prayer for drunk Michael Saylor because, the margin calls are about to hit, folks. Yep, MicroStrategy, once that Bitcoin goes below 20,000, it's over. The whole charade is over. Things are bad across the board, folks, in this economy. We have shortages all over the place, not just in tampons, but we also have a shortage in sriracha now. So you might say, well, what am I going to do with my eggs? How am I going to spice up my eggs? How am I going to get some heat in my body? Well, maybe you don't need sriracha because the price of eggs is going to make your blood boil. Because inflation in eggs has reached 161% year over year. This is the booming economy. And speaking of the booming economy, why are we seeing all of these shortages? The answer is hoarding. Why are folks hoarding? Because they believe that the price tomorrow is going to be much higher than today. Welcome to the United States of Zimbabwe. And therefore, they stampeded and they bought srirachas and tampons. And you know what else? Coming next, diapers. You're going to need a lot of those. Because inflation expectations are surging out of whack. And today, the New York Fed announced data that consumer inflation expectations have reached all-time highs once again. The same levels from back in 2013. Now, that was a fake panic. That was unmerited, but this one is the real deal. And you know what? When it rains, it pours. Just lay it on me. Hit us. When they say peak inflation, here's peak inflation for you. New car prices rose again. Everyone paying over sticker. You see what's going on here? When you have high inflation expectations, folks are stampeding and buying cars, goods, whatever it is, doesn't matter. And they're willing to pay above the sticker price because they believe that if you pay above the sticker price now, that's a deal. Because a few months from now, matter of fact, a few weeks from now, the above the sticker price would actually look like a discount. Again, welcome to the United States of Zimbabwe. And the bad news keep on pouring. Economists now say that the U.S. is likely to fall into recession in 2023. I say scratch that. How about 2022? We're already in a recession in certain areas in the economy. And of course, renowned economist Mohamed El-Erian comes out and says we are now in a period of stagflation that could devolve into a recession. All of a sudden, the R word is being thrown all over the place. Pretty soon, the Ministry of Disinformation will come out and say, hey, if you say the R word, you're a propagandist for Putin. But it doesn't matter, folks, because the facts, the numbers, the reality is here. We're now seeing a re-inversion of the yield curve. And this is the second time we have an inversion in the yield curve in this year. What does that mean? Now we have a confirmation. We will have a recession a year from now, 1 million%. It's in the bag now. You want to make a sure bet in life? Go to the casino and say, I want to bet for the odds of a recession next year, because that's guaranteed to make money. Why is the yield curve inverting? The answer is the 10-year is surging out of whack, and it is now reaching levels that we haven't seen since 2011. But at the same time, the 2-year yield is racing like Usain Bolt, and it is bolting past the 10-year yield, and hence the inversion of the yield curve. And now the 2-year, and this is important by the way, because the 2-year is as close as you can get the Fed funds rate. So when the bond market says the 2-year should be at what now? 3.5%? What is the bond market saying? The bond market is saying, Mr. Powell, you better wake up from the coma and raise that Fed funds rate to at least 3.5%. Here it is. After the CPI came out, expectations of rate hikes went significantly higher, and hence the repricing in the equities market, repricing to the downside. So if you want to sound smart, when somebody says, why is the stock market crashing today? Now you know how to explain it. You say, look at this. Expectations of Fed rate hikes went higher. When those expectations go higher, equities have to reprice down because higher interest rates mean that the valuations have to come down. Simple as that. And that's going to make you look smart. You might even get laid. But you better be into blood because there are no tampons. You know who else has to walk the walk? The Federal Reserve, Jerome Powell, because the 2-year is saying get it to 3.5% now. Even I said the bazooka is 2.5%, but the bond market is saying 3.5%. 2.5 is not going to do anything to this inflation. And guess what? Here comes Jerome Powell to the rescue. Breaking news.
All right, welcome back. We've got a news alert on the Federal Reserve. Steve Leisman joining us down the fast line with more. Steve.
Brian, thanks very much. I just want to say my reporting at this point is that a 75 basis point rate hike to be announced at the second day of the meeting this week on Wednesday is very likely, a real distinct possibility. I think things have changed for the Federal Reserve. The CPI coming in hotter than expected. University of Michigan inflation expectations, consumer expectations in the New York Fed. I know that Powell said that the committee back in May was not actively considering it, but he also said that they were looking at the economy, and I think the economy has changed to the point, and my reporting is such that at this point, I'd be dialing in a 75 if I were a betting man at this point, not a 50.
Would that quickly, Steve, great reporting, would that quickly then...
Yeah, you know why Steve Leisman has great reporting? Because he has access to the Fed. All of this bootlicking that you see in CNBC, that's how they get access to the Fed. And somebody leaks the information to Steve Leisman from the Fed. And we have the picture, the identity of the leaker. Here it is. Yep. You want things to go higher, much higher. And folks, there is fear in the street. All that bravery, in the crypto tulip mania, that fades away immediately and becomes fear when we have days like this that we got today. The fear index in Europe is surging like we've never seen before. Matter of fact, the highest reading since May 2020. So I guess we've seen it before. Anyways, I tried to make it sound dramatic, but here's something dramatic for you. Have you seen the put to call ratio in the CBOE? Well, not looking good here. It looks that we're about to have another massive pop, the likes that we've never seen since the crash of the thing back in 2020. The pre-ape era. And here's another ominous indicator for the equities market, for the economy. Look at the LQD. This is for corporate bonds. We're seeing the biggest exodus in history. Now, a sign for a bottom is when you see inflows, record inflows in the LQD. We saw that back in the crash of the thing back in 2020. That's when everybody stampedes and buy the LQD. When we see massive outflows, that usually precedes a massive crash. We've seen that back in 2016, the Brexit crash. We've seen it again in 2018, the Jerome Powell autopilot rate hikes. I know there was no soft landing in this one. Jerome Powell raised interest rates higher. The moment stocks went down and the rich, the oligarchs, picked up the phone and started yelling at him, he crashed that autopilot down to zero to be accommodative, quote unquote, to the stock market. And we've seen it again back in 2019, right before the crash in 2020. So this is a bad sign. But if you feel afraid, if this is all FUD for you and you're going to run to CVS right now, whatever store you have next to you, and stampede and hoard a bunch of diapers, please don't do that because you got some optimism here. Look no further than Tom Lee, who's now got exposed as the fraud he is. We predicted that, by the way, in this channel. We said that Tom Lee's a glorified palm reader. That's all there is. But Tom Lee says the stock market can return to record highs this year as inflation shows signs of cooling down despite May's hot CPI print. The facts don't matter, the truth don't matter. Just put your blindfold on and continue to buy. So Tom Lee can short privately and take your money away. Or, since a lot of you criticize me and say, hey, you don't give us the tickers anymore, you don't give us what to buy, what to sell, what's going to go higher, to the moon. Well, I just told you want a sure bet in life. Number one bet for a recession, that's in the bag, 100%. Number two, inflation going higher. That is sure bet number two. It's in the bag. And sure bet number three, in the bag is buying call options on Top Gun Maverick. That thing is on fire, and it's about to reach $1 billion in the box office. Anyways, folks, we're going to keep this short and sweet because I'm taping this already too late. It's about 9 o'clock here, Pacific time. In the evening, of course, just in case you were wondering. But for new subscribers and viewers, I have a full-time job besides this, and I've been busy with lawyers all day long. No, I'm not in trouble, but it is what it is. The good news is I'm not going to be as busy as I used to, at least all the way till the end of the week. So expect some pleasant surprises to come from this channel. Anyways, let's move on and cover some charts for you, and then we go to sleep. And here it is. We start with SPY 30 minutes chart. What's going on here? A massive gap down. The support of 385 is gone. Matter of fact, the support of 380 was gone. So you got your shorting signal confirmed, not once, not twice, but a third time. Now, the good news for the bulls is the following. We are at support and the RSI is way oversold, so we could get a bounce. If we get a bounce, let's say in the rosiest of scenarios for the bulls, let's say the SPY surges all the way back to 385. That would be resistance. And if magically it moves all the way to close the gap, then we'll know it's over. But absent of that, any rip is to short in the meantime, until of course the Fed meeting, the FOMC on Wednesday. Now, don't place high hopes on the Fed meeting on Wednesday because Jerome Powell, he's not going to use the bazooka. He's going to use the 75 basis points and he's going to think that he's a tough guy. But the market wants more. How do I know? Look at the 2-year yield. The bond market is saying more, Mr. Powell, more. We want the nuke. Forget about the bazooka. Hit us. And some of you looking at this chart would say, hey, Maverick, that is so convenient for you. You picked the support right at the bounce by the end of the day, 373.5. Wow, what a genius. No, bitch, I did not. You have to move back all the way to, let's say, around January of 2021. You see that gap in the SPY? That's 373.5. This is how we got the support. So could we get a bounce? Yes, we could, but that bounce would be the fade. Here's the daily chart for the continuous contract for the SPY, a bloodbath across the board, a massacre, flushed down big time, and we lost the support of 3,855. We're now looking at 3,600 as support, but we might have soft support if we use 3,720.5. We're almost there. We could get a bounce, but again, for now, all of these bounces, all of these rips, if they happen, are to fade because look at the volume. It surged higher, significantly higher. The VIX is moving higher. The momentum indicators reversed in a dramatic fashion. All of these are bad signs. Maybe when the VIX gets to 40, for example, plus 40, and then the Fed comes out and we see lots of panic and the chart is now at 3,600, for example, maybe then we will talk about a rebound and a bottom when we get there. But for now, buying the dip is just simply too risky. Now, let's take a look at the SPX, the cash index for the S&P 500. What do we see here? The point from this chart is we know 4,000 has lost its support, and the chart has a long way to go if it wants to go to the downside. The RSI, the MACD indicator, we're not seeing any oversold signal here. We could go even lower. But look at all of these gaps. These gaps are going to close one way or the other. What would be the catalyst? We don't know. But they're going to close one way or the other. So if you think that this is it, meaning the crash, you're sadly mistaken. We're going to get another bounce. We're going to close all of these gaps. People are going to feel that we're back. You buy the dip all in, and then they're going to flush them down again by the fourth quarter of this year. What about the Qs, the NASDAQ? What's going on here? Similar story, a gap down and closing at the lows of the day. This is not a good sign, but for the bulls who are desperate right now, I mean, the bears are already shorting. There's nothing new here. And they could double down, triple down until we get to the FOMC minutes. But for the bulls, you got number one, the RSI indicator is severely oversold. Number two, we are at support of 274.65. Now you might say, hey Maverick, that is so convenient for you to choose 274.65 as support. Wow, what a genius. Nope. If you go back to November of 2020, the gap higher, the Biden gap, that was at 274.65. So we're stopping at that exact support. And by the way, speaking of Joey B, his entire rally is about to be erased. Wow. What about the daily chart for the continuous contract for the NASDAQ? A bloodbath, and now we lost 11,689. We're looking at 11,000. I'm looking at 11,058.5, but again, you can round that down to 11,000. It's not going to matter. The volume went higher, significantly higher. A good sign for the bears, bad sign for the bulls. The momentum indicators, the MACD indicator, already has a crossing. And it appears that we have a confirmation for now. What does that mean? The bullish momentum that we enjoyed for 5 minutes? That's gone now. We're starting new, fresh, bearish momentum. Unless, of course, Jerome Powell extinguishes the fire and rescues the stock market, and the tulip market for that matter. But what would it take? Well, according to the bond market, it takes 3.5% on the Fed funds rate. Do you do that right away, all at once? I doubt it. But at least use the bazooka and get us to 2.5%. If Jerome Powell is listening, 2.5% immediately. I know the staff is listening. The staff is watching this channel, Jerome Powell's staff. So get this information to him. Use the bazooka, 2.5% immediately. No more games. And here's the IWM 30 minutes chart. Initially, there was an attempt to capture 174.22 as support. And if you zoom in to a minute chart or a 5 minutes chart, you're going to see the importance of 174.22 illustrated, because the chart gave it multiple shots in cracking that exact number, that exact zone, which tells you that this zone, this number is important. And now we lost that. So that becomes stiff resistance now. The good news for the bulls. You got 168.90 as support. That's number one. Number two, the RSI is severely oversold. Number three, what if this is a double bottom? We're going to bounce all the way, in the best case scenario, all the way back to 174.22. It could happen. But the moment you breach the double bottom support and the confirmation would be breaking below 168.90, you know that we're going to see another big flush down. The Dixie, the dollar index, what's going on here? To the moon. You have the Japanese yen crashing, the expectations of a more hawkish Fed, more interest rate hikes, thus the dollar is moving higher, significantly higher. And it is under new, fresh, bullish momentum, meaning it could go a lot higher. It's not even closely or remotely close to being overbought. And a higher dollar is bad for equities. It is also bad for gold. Now, it was baffling. Why would gold rally hand in hand with the dollar? This happened last Friday, and I said this is an indicator of extreme fear. But I'm not going to make a big deal out of it without a confirmation. Well, we don't have a confirmation. We have a reversal. And now gold lost 1,840 as support. It is making a lower low. This is not looking good, folks. The momentum indicator, the MACD, it is about to cross to produce negative impressions on the histogram. Now, I'm still bullish on the miners, but honestly, this is not a good looking chart after it lost the support of 1,840, and as the dollar continues to move higher. The dollar has to go down. Now, the 10-year yield could pop higher. Gold can perform under these conditions, but the dollar has to go down. Here's UK oil, Brent. This is a 4 hours chart. Now, it's hard to say whether this is a bullish or bearish look, but in my eyes, this is a bullish look indicating that Brent could crack above 124 once again. Because think about it. Everything was down. Equities, cryptos, metals, grains, farts in a jar, everything was down. But somehow crude made a rebound that closed at the highs of the day, almost. This is a sign of strength, not weakness. We'll see if it is a false sign or not, but for now it looks as if crude wants to break above 124. What about the 10-year yield? Whoa! Look at that pop. Accelerating the bullish momentum in both the RSI and the MACD indicator. Now we're eyeing 3.5. That could be a psychological number where we see buying of bonds, and it could be soft resistance at least in the short run. If that is the case, that would be good for the TLT, but mind you, the ABC pattern we've been talking about for a while now, not going to happen now because the chart is below the A leg, so that's gone. The good news is we have support at 109.5. If we get a rebound, that could get us back all the way above 112.86, but most importantly, it has to move us above 125.12. Now, what will be the catalyst, the fundamental catalyst for such a bounce? I don't see any, frankly speaking, but if Jerome Powell comes out aggressive and he uses the bazooka indeed, that could actually tame the 10-year yield. Not because inflation is going to go down immediately, but because it gets us closer to a recession, and hence the growth in the economy goes down. or slows down. Now you might say, why would you encourage Jerome Powell to produce a recession? Because recession right now is the best case scenario. And here's the VIX from a 4 hours chart perspective. We got the ABC pattern. It got us above 33. Now 33 becomes support. The bullish momentum on the RSI indicator is kind of peakish for now. The RSI also getting a little overbought. So again, we could see a pullback, maybe a loss of 33 as support. That will be subsequent to a pop higher in the SPY, for example. But again, we talked about any pop is a rip to fade, meaning any dip in the VIX is to be bought right now until we get the FOMC meeting out of the way. Here's the VXN, similar look here, but it's not getting as overbought as we're seeing in the SPY. It is facing resistance at around 40, but if we get a pullback, let's say the Qs rebounds higher overnight, it opens gapping higher in the morning, and then it pulls down, then we could see the opposite story here in the VXN. It could go down to close some of these gaps, and then it rebounds higher again. What about Apple, the big kahuna? What's going on here? It lost the support of 138.79 for good. It pierced below the last low. All of these are bearish signs, folks. You combine that with higher than average volume on a down day. On top of that, we have the MACD indicator crossing, producing red impressions on the histogram, confirming that the bullish momentum is over. We're now starting new bearish momentum. The chart is not oversold by any means, so we could go down to the next support, which in my chart is 127.22. Tesla, the souffle, what's going on here from a 30 minutes perspective? The good news for the bulls is the following. We have what it appears to be a double bottom for now. We have yet to get the confirmation this is a double bottom, but the RSI is getting a little oversold here. The problem is, what if we get a bounce in the morning? Then we're going to have resistance number one, the top of the candle, which is around 680, and then we have 700 once again. I doubt that it's going to get to 700 and close the gap, but if it decides to go down, you're going to know that immediately by piercing below the previous lows. We will look at 620.50. Now, why did I choose this number? The answer is, if we go back in Tesla's chart all the way, this is a daily chart, by the way. Let's say the summer of 2021. If we remove all of these markings, here it is, 620.5 was the center of gravity of the chart. We have seen multiple reactions at around this number, both as support and resistance. And this means that this number is important. It should hold the support, but if it breaks, you're going to see a cascading impact of selling. The algos trade within these numbers, within these support and resistance lines. You breach support, you trigger the algos to do more selling. You capture a rebound from an important support level, you get more buying by the algos. Of course, we have more bad news from the souffle. It appears that business is slowing. We heard news about pausing hiring in Shanghai. Now we're seeing layoffs in Singapore. These are all telltales that Tesla is facing a problem. Perhaps a demand problem. Perhaps a shortage and supply problem. Whatever problem it is, the business is slowing down. Growth is slowing down. This stock is a growth story. We've been excusing the insane valuation because growth was intact. If growth goes out of the window, no more excuses to pump the valuation of the souffle higher. And lastly, what about BTC tulips? What's going on here? Whoa! What a beating. It is getting oversold, but are you really going to buy here? I have support at 19,550. Now, everybody's eyeing the 20,000 round number. The algos could react, but for me, conservatively speaking, I like 19,550. If we get a bounce from that point on, and a confirmation of the bounce, and you have to be picky when you buy dips in Bitcoin at this point. And before we move on, I received multiple questions from you guys about solar stocks, about defense stocks, about CrowdStrike, because I talked about that stock, shorting it on Friday. I'm going to cover all of these charts and a lot more tomorrow, because right now I'm already taping this too late. So let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the Small Business Index and we have the PPI, the Producer Price Index. Both of them are important as a pulse of the inflation in this economy. So buckle up your seat belts, grab the popcorn, but this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.